All right, let's talk about something that's on the mind of every entrepreneur: taxes. We're going to break down what it really costs to get a business off the ground, from that very first dollar all the way up to your first million.
So picture this. You've got that brilliant idea, right? The business plan is all mapped out and you are just itching to flip that open sign for the very first time. You're finally an entrepreneur.
But hold on, before that first customer ever walks through the door, your business has to, legally exist. So what is the price of admission? What does it actually cost just to get started?
And that's where things start to get, well, a little complicated. It's not just one simple number. The answer is this giant puzzle that really depends on two huge factors: where you are and how big you are.
Okay, so let's start at square one. The very first hurdle you're going to face, the filing fee. This is the money you have to pay the state just to say, hey, my business exists.
Let's say you want to form an LLC, a limited liability company in Ohio. You file some paperwork, your articles of organization, with the Secretary of State. And the price tag for that? A one-time fee of just $99. Seems pretty straightforward, right? But what happens if you're just a few states over, in Alabama? You're doing the exact same thing, filing a certificate of formation for your LLC. But now it's going to cost you $225. We're talking more than double the price for the exact same legal step. Wild.
And believe me, it doesn't stop there. Let's say your business is crushing it, and you decide to expand into Texas from another state. Well, now you have to register as what's called a foreign LLC. And that fee? It skyrockets to a whopping $750.
Oh, and on top of all that, there's this little hidden cost a lot of people don't see coming. Every state says you need a registered agent. This is basically just a physical address in that state where they can send official legal mail. So if your business isn't physically there, you've got to hire someone for the job. And that'll tack on another $100, maybe $300 to your costs every single year.
All right, so you've paid your fees, you're officially in the game. But that was just level one. Now we're heading into the main event, the never-ending 50-state tax maze.
Just take a look at this. This map says it all, doesn't it? It shows the absolutely wild differences in how states handle business taxes. I mean, you've got rates up over 11% in some places, and then you've got others that are literally zero. It's a total patchwork.
But here's the thing. Those percentages on the map, they don't even begin to tell the whole story. The real complexity, the tricky part, is what each state decides to tax. Their whole philosophy on how to tax a business can change the second you cross a state line.
Okay, let's take two states right next to each other. In Tennessee, your business pays something called a franchise and excise tax. It's basically a combo deal. They tax you based on your company's net worth plus its net earnings. But then you hop over to Ohio, and suddenly there's no corporate income tax at all. Instead, they have what's called a commercial activity tax, and it's based on your gross receipts. That means they're taxing your total revenue, not your profit. Think about that for a second. A business could be making tons of sales, but have a tiny profit margin and get hit with a massive tax bill in Ohio while paying almost nothing in Tennessee. It is a completely different ballgame, depending on where you set up shop.
All right, we've been focused on the state level. Now, let's zoom way out to the global stage. This is where the numbers get absolutely mind-boggling, and the strategies, well, they become incredibly sophisticated.
For huge multinational companies, one of the biggest tools in their toolbox is something called tax deferral. And it's actually a pretty simple idea. If a U.S. company makes a bunch of money through one of its companies overseas, it usually doesn't have to pay U.S. corporate tax on that cash, at least not until they decide to bring it back home to the States.
So how much money are we really talking about here? You might want to sit down for this. Back in 2015, the government estimated that U.S. companies were holding, get this, $1.7 trillion in untaxed profits offshore. That's trillion with a T.
So you have to ask, why would they leave all that cash just sitting overseas? Well, it's a strategic play. One law professor pointed out that companies were basically holding out, hoping Congress would repeat something they did back in 2004, offer a tax holiday. That's when they could bring all that money home and pay a super low tax rate, just over 5%. So it's a huge strategic gamble.
And we're not talking about some obscure loophole used by a few companies. No, we're talking about the biggest names you can think of. Companies like Apple, Microsoft, Google, Pfizer, they've all been known for keeping massive amounts of cash in their overseas operations. Okay, so after seeing all that global complexity,
Let's bring it back home. Let's zoom back into the state level and look at a totally different approach, one that's all about simplicity.
So, after everything we've seen, what if a state just looked at that crazy, complicated map of tax rates and said, you know what, we're out? What if they decided to make their corporate income tax rate 0? Not as some weird loophole, but as their actual core strategy.
Well, it turns out a few states have done exactly that. If we look at the map again, a couple of places really pop out, like South Dakota and Wyoming. These guys have no corporate income tax, and they don't have a gross receipts tax like you see in Ohio or Texas. And because of that, they've basically become magnets for specific kinds of businesses.
In the story of Sioux Falls, South Dakota, is the perfect example of this in action. Here's what happened. Back in 1978, a Supreme Court ruling opened up this legal loophole for interest rates. South Dakota saw its chance and, in 1980, completely got rid of its caps on interest rates. And guess what happened just 1 year later? Citibank packed its bags and moved its entire credit card operation to the state. Just like that, it turned Sioux Falls into a major financial hub.
So we've gone on quite a journey here, right? From a simple $99 filing fee all the way to trillions of dollars stashed offshore, and then all the way back to a small city in South Dakota. So what's the big takeaway? Here's the most important thing to understand. There's really no such thing as one U.S. business tax system. It's more like a system of systems. It's this complex, messy web of competing rules where cities, states, and the federal government are all vying for revenue and trying to attract businesses. It's a system that scales from a simple $99 fee at one end to a $1.7 trillion global financial dance at the other. And all of this leaves us with one big question to chew on. Is this incredible complexity a bug, or is it a feature? Is this a broken system that desperately needs to be fixed and simplified? Or is this chaotic patchwork of competing interests the very thing that actually fuels competition and innovation between the states? Something to think about.